The banking crisis of last spring has not gone away. In fact, it is back, and we're staring down the barrel of some pretty big things. Things are happening in the background, and we're starting to see stock markets starting to take a little bit of notice here. If you wondered why the stock market is expecting the Federal Reserve to start cutting interest rates in March, because according to the Biden administration, that, employment is up and inflation's under control. So why in the world would they start cutting interest rates? What's the problem that they're trying to counteract? And the answer to that is what's happening in the banking system. Friends, on Wall Street, they're talking about this. In the back rooms of financial planners' offices, they're talking about this. They're not talking to you about this, but I want you to be aware of what's going on the inside of the financial industry, and we're going to talk about that right now. I'm going to walk you through what has them so freaked out that has Goldman Sachs dumping stocks right now. These companies and these big institutions are scared, and there's good reason for that. And I keep hearing from retail investors, I keep hearing from normal everyday people who have retirement funds and stuff like that in the stock market right now, and they think that everything is great, that everything's going to keep going up, and I'm worried for them. So that's why we're going to talk about this. Let's jump into it. Welcome to the Poplar Report. If you haven't been here before, appreciate you being here. If you haven't already hit the subscribe button, make sure you hit that, because I've been hearing more and more from you guys that my videos are being hidden from you all. Make sure you're subscribed and hit that little bell icon so that you get notifications. But I put out at least two videos a day, 6:15 a.m. Eastern Standard, and then usually one in the afternoon as well. All right, so what's going on out there? The big thing that nobody really wants to talk about is the office real estate particularly. These office mortgages are now hitting 6.5% delinquency. So of all the mortgages out there in dollar volume that are securing office buildings out there, 6.5% of them haven't made a payment in the last month. And that's kind of concerning, because this is supposed to be one of the safe places in the market. Just as subprime mortgages were safe in 2008 until they crashed, office parks, office buildings are supposed to be a very safe investment. And so a lot of banks have a lot of office property on their books, but nobody's going into the office anymore. Now, perhaps you don't have one of those luxury jobs where you get to work from home, but a lot of people have started working from home. Government offices work from home. A lot of financial and legal and stuff like that, they're working from home. These office buildings, by and large, are empty. And a lot of them are not getting rents from companies. And so the owners of these office buildings are starting to let them go delinquent and are going to default on them at some point. And who's going to get stuck with that? The banks. The banks are going to get stuck seizing a building that isn't worth as much as the loans that they have out on it. And that is going to be a serious, serious problem. And they don't want to call out these defaulters yet, because that would transition that asset from the people borrowing the money to the bank itself. And the bank, when they take that hit, they're not going to be able to sustain that hit. So what they're doing is they're playing the games in order to pretend like they're not about to take this massive loss. And so banks are panicking. They've already borrowed over $140 billion from the Federal Reserve emergency loans. They have a facility, as they call it. Basically, they have a way so that banks can borrow money from the Federal Reserve for emergency purposes to keep afloat. Well, the banks are utilizing that $140 billion. And when you start thinking about how banks often take that cash and start levering up on it 10 to 20 times, we're talking about a very, very large set of investments that they're trying to offset right now. So the office market out there, mortgage market is $4.6 trillion. Now, when we look at compared to 2008, we were talking about a $1.3 trillion subprime mortgage market. And now we're talking about a $4.6 trillion market potential collapse. And I said that the delinquencies had passed 6.5%. That's also kind of an important number. Why? Because what caused the crash in 2008? When subprime mortgage delinquency rate hit 6.4%, that's what triggered things. That's when things started cascading. That's when people realized there was a problem and the banks started trying to unload these toxic assets. And so now we are passing that 6.4% threshold. We're now at 6.5% of the loans are now delinquent. We're in that crash zone. And Goldman Sachs realizes that, and that's why they've been selling stocks. They've been telling their retail people, they've been telling the you and I's of the world, keep buying because things are great. Meanwhile, the institution itself has been selling stocks like nobody's business. We're seeing a lot of institutions dumping assets, dumping stocks. And on top of that, not just the real estate side of things, the office real estate, but we're also talking about banks are dealing with, they have a lot of U.S. Treasury bills. They have a lot of bonds. So bonds are just basically loans, right? That they're loaning to municipalities, or they're loaning to the federal government, or they're loaning to other businesses even. This bond market, the problem is they have all these bonds that are at like 1%, 2%, 3%, and they should be getting 6, 7, 8% right now for a lot of these things. And they're not, which means that those bonds have their face value is much lower than what they bought them at. So you buy a loan, you loan out money at 1 or 2% when interest rates are at 0%, right? But then now that you could be getting 6, 7, 8% interest for that money, you're still stuck only getting the 1 or 2%. That's a problem because you are effectively losing money every single month. And that's what we're seeing with banks right now is they're loaded up to the gills on loans that have an interest rate that's lower than the current interest rate. And so they can't sell those loans to anybody. Nobody wants them. They'd have to discount them significantly. This is what we call unrealized losses. They've lost their shirt, but they're pretending they haven't. And they're still like, yeah, we have like $2 billion worth of loans over here we can borrow money against. But the fact is those $2 billion worth of loans ain't worth $2 billion anymore, yet they're still borrowing against them. How bad is it? I guess that's the real question. Well, in Q4, so the last 3 months of 2023, they lost another $700 billion. And that's unrealized. They've lost it, but they haven't sold the assets yet, so they haven't admitted that they lost $700 billion. Banks lost $700 billion in the last 3 months of 2023. Does that sound like a lot of money? Because it's a lot of money. And yet we've seen all 4 quarters of 2023, they lost over $100 billion per quarter. $700 billion is the worst so far. But each quarter they lost billions upon billions of dollars. And most of these losses still are not booked yet. Now they're hoping that the Federal Reserve starts cutting interest rates. And when the Federal Reserve cuts interest rates, they can then get out of these things, out of these loans at a profit. That's what they're hoping. But the problem is, if Federal Reserve and if interest rates don't actually come down, they're stuck in a hole, a big hole. So it's like, imagine if the stock market crashed, right? And you bought your stock up here and it goes down. You can be like, well, I'm just going to wait until it goes back up. That's what banks are. Bonds kind of do the inverse of what stocks are right now. So right now, bonds have crashed through the floor. And all these banks are holding all these assets that are like worth half the value of when they purchased them. and we're talking about hundreds of billions of dollars, we're talking about trillions of dollars of losses. If they were all forced to sell right now, they would be just, the banking system would just be gone. That's kind of where we're at right now, and it's really just a matter of them pretending that nothing is going on right now. They're expecting rate cuts to start in March. They're expecting the Federal Reserve to come in and start cutting interest rates, because if they don't, the banking system will implode. You're starting to see the problem here. The banks know there's a problem. They can look at their balance sheets and say, we're toast. Even if the Federal Reserve starts cutting, they have to start cutting really, really hard and fast. The only thing that's going to cause the Federal Reserve to start slashing interest rates dramatically is a stock market crash. And they're telling you that they think that stock market crash is going to happen before March. Is this a good time to be loading up to the gills on stocks? Probably not. Is this a good time to be, I don't know, moving your retirement funds out of stocks and bonds over into gold, silver, platinum? It probably is a good time for that. It's not financial advice, but that's just logical experience kind of talking. We're looking at probably a massive market crash before the Federal Reserve starts cutting interest rates. And there's something else that's happening in March that has people kind of thinking that this is going to be an instigator here. But the thing is that that $140 billion of emergency loans they're getting out from the Federal Reserve, that program ends in March. So basically, if the Federal Reserve shuts down that program, which they're expected to do so, because there's a lot of banks abusing it, apparently, that means that the banks are going to be stuck losing $140 billion in cash over the course of the next couple months. They're going to have to come up with that cash from somewhere. And the last six quarters, 2.5 years, 1.5 years. The last 1.5 years, banks have been losing deposits. From you and me sticking our money in the bank, we've been losing deposits. They've been losing those deposits for the past 1.5 years, every single quarter. They lose more and more and more. And this is what they borrow against in order to do all their speculative trading. And this is really putting them in a cash crunch. And if the Federal Reserve basically essentially takes $140 billion out of their pockets there, it's going to start a cascading failure across the board. That's what the smart financial planners are worried about. They're looking at their watches nervously and thinking about scooting for the door, and they're positioning themselves more and more defensively because they are worried that this is exactly what's going to happen, that there is going to be a liquidity is going to go out the door. All the cash is going to disappear, and people are going to start being forced to sell stuff. Particularly banks are going to be forced to sell stocks. They're going to be forced to sell bonds, and it's going to soak up the cash. The cash is going to go bye-bye. And people are going to be forced more and more and more to sell, and you're going to have essentially a market crash. They're expecting that in the next 2 months. So do with that as you will, but I'll tell you this. If you look at these investment trading firms and stuff like that, they're getting more defensive. They're starting to protect themselves more. They're buying protection. They are selling some of their more risky assets. That's what's happening out in the market right now. So you can keep on buying stocks, thinking that sunny days are here to come and here to stay. But all the people invested in the markets that really are insiders and they know what's going on, friends, they're not as optimistic as you are. So take that information, do with it as you will. If you want to find out more about what you can do with your retirement accounts to get them out of stocks and bonds into things like gold, silver, and platinum, there's a link right here for Genesis Gold Group. They're fantastic folks. They'll answer your questions and let you know what you can do. If you want to check out another video from this channel, there's one right up here. Thanks so much for watching. Steve Poplar of the Poplar Report, out.